What if I told you that there are 7 superannuation strategies that can legally save you thousands of dollars in tax that most Aussies don't know about? If you're feeling frustrated by how much of your hard-earned money you're giving to the ATO each and every year, I'm going to show you the blueprint to legally reduce what you owe to the ATO. Miss this video and you could be handing over more money than you need. And make sure you stay till the last strategy, because that one could result in you having over $1 million in tax-free earnings at retirement. Now, before we dive into the exact strategies, I firstly wanted to talk about the difference between concessional and non-concessional superannuation contributions, because it's crucial to understand the differences, because they are fundamental to the strategies that we're going to be talking about. Concessional contributions are a voluntary payment from your pre-taxable income into your superannuation accounts. This includes any money that you choose to salary sacrifice, any personal deductible contributions, and also the contributions that your employer makes on your behalf. This is currently at 11.5% this year, but it will increase to 12% at the start of the next financial year. The important thing to know about concessional contributions is that it can give you an immediate tax benefit, as all of these contributions are only ever taxed at 15% versus your own marginal tax rate, which could be as high as 45%. So if you are someone who was on the highest tax bracket, this means that for every dollar that you're contributing into your superannuation account, you're receiving an immediate 30% benefit. Now, this concessional tax rate is only available to those individuals who earn less than $250,000 per year, including super. If you're someone who earns above this, then you'll fall under what is known as the Division 293 rule, and you'll essentially incur an additional tax on your superannuation contributions. Another important thing to note about concessional contributions is that there is a yearly cap currently of $30,000. If you exceed this cap, then the excess concessional contributions will just be included into your assessable income for that year, and you won't receive any additional tax benefits. It may be possible to increase the cap by using what is known as the carry forward rule, which we'll talk about later on. Now, a non-concessional contribution is a personal payment that you make to your superannuation fund. It typically comes from your after-tax income that you have sitting around in your bank, or perhaps you've recently received a large lump sum payment like a windfall and you want to contribute that to your superannuation as well. There is a non-concessional contribution cap of $120,000 per year, or possibly even more if you use the carry forward rule. Now, there's no immediate tax savings when it comes to non-concessional contributions, but the tax benefits do come about later on in your life. Once you turn 60, you have the option to start a super pension income stream. And essentially, your super's investment earnings and any income streams and dividends that you might receive are now all tax-free. So now that we understand the differences between concessional and non-concessional contributions, let's talk about the strategies that you can use to legally reduce your tax. The first strategy, which we've already touched on before, is salary sacrificing. Salary sacrificing is one of 3 ways that you can make concessional contributions to your superannuation accounts. Essentially, instead of receiving all of your fortnightly or monthly salary straight into your bank account, you can ask your employer to direct a portion of that directly to your superannuation account before any tax is taken away. This can help you save on tax and build your super faster, because concessional contributions, as discussed earlier, are only ever taxed at 15% versus your own marginal tax rate. For example, if someone had an income of $120,000 and decided to salary sacrifice $10,000, that $10,000 would be taxed at 15% versus their own marginal tax rate of 32%, which means instead of paying $3,200 worth of tax, they're now only paying $1,500, which results in an immediate tax saving of $1,700. At the same time, because that money is directly deposited into your superannuation account, it will be invested into the stock market, and then you'll be benefiting from compounding returns. The higher the tax bracket that you sit in, the more benefits that you'll actually receive from salary sacrificing. For example, for someone earning $200,000 who decided to salary sacrifice the same $10,000, they would have a marginal tax rate of 47% and end up paying $4,700 worth of taxes if they didn't decide to salary sacrifice it, versus paying the same $1,500 in taxes, which results in a tax saving of $3,200 in this scenario. The second strategy is known as a personal deductible contribution. This is relevant if you're someone who's self-employed or your employer doesn't offer salary sacrificing. This is the second way to make a concessional contributions, and it simply involves using your own savings that you have in the bank and then contributing that to your super. Now, you are using money that you've already paid tax on, so in order to claim the tax benefits, all you'll need to do is complete a notice of intent form and then submit that to your superannuation fund before the end of the financial year. The tax savings that you'll receive from this strategy are exactly the same as the previous strategy with regards to salary sacrificing. And by the way, if you want to receive more personal finance tips from myself, in order to live a healthier and wealthier life, subscribe to my free weekly newsletter down below, where I share weekly personal finance tips and updates from myself. Now, building on the previous strategy number 3 is using your carry forward concessional contributions. If your total superannuation balance is less than $500,000 as of 30th of June the previous financial year, you may be eligible to contribute more than the concessional contributions cap by using any unused contributions over the last 5 years, which is otherwise known as carry forward concessional contributions. As I mentioned earlier, the current concessional contributions cap is $30,000. But not everyone always contributes to that amount each year. If you've gone under this amount, this strategy essentially allows you to catch up on your superannuation contributions. The contributions cap has been steadily increasing over the previous 5 years. So 5 years ago, the concessional contributions cap was only $25,000. So for example, let's assume that over the last 5 years, you've only contributed $15,000 each year to your superannuation. This means that you have unused concessional contributions that can be carried forwarded, totaling $57,500. Now, because it is a rolling 5-year period, if you don't use up the unused contributions from the 5th year, then you will unfortunately lose it. Now, in order to use any of the carry forward contributions from the previous 5 years, you must first have used up the concessional contributions cap this year. The good thing is that when you begin drawing down on your carry forward contributions, it firstly takes it from the 5th year that is about to expire, which means if you didn't want any of it to expire, you could just contribute enough to use up the contributions in that 5th year. The fourth strategy is known as the government co-contribution scheme, and is a strategy that you can take advantage of if you're a low or middle income earner in Australia. If you make a personal contribution to your superannuation fund, then the government may make a co-contribution of up to 50%, capped at $500. So for example, if I was earning $40,000 this year and I made a personal contribution of $1,000 to my superannuation account, the government would match that by up to $500. That's essentially an immediate 50% return, or $500 from the government. Whilst this isn't necessarily a tax deduction, it is going to go a long way towards helping you boost your superannuation balance. Now, there are different income thresholds which will determine how much of a co-contribution the government will make. If you're earning more than $60,400, then you won't be eligible to receive any co-contribution. But if you're earning less than $45,400, then you'll be eligible to receive the maximum co-contribution. And if you're earning anything in between, then it will be a tiered amount as to how much you'll receive. The fifth strategy is known as the spouse co-contribution. This is when one partner adds money to their spouse's superannuation account. This can not only help boost the receiving spouse's retirement savings, but may also provide a tax saving to the partner who's contributing the money. And this is how it works. If your spouse is earning less than $40,000 per year, then you can contribute up to $3,000 to their account and receive an 18% tax offset capped at $540 per year. The sixth strategy is known as the First Home Super Saver Scheme. If you're a first home buyer, then you should definitely learn about this strategy as it allows you to withdraw your personal deductions from your superannuation account to use as a deposit. Now, only voluntary contributions are eligible for withdrawal, so through salary sacrificing or personal deductible contributions. You can apply to withdraw a maximum of $15,000 worth of voluntary contributions from any one single year, capped at $50,000 in total. In addition, you can also withdraw any investment earnings that those contributions have also made. The tax benefit here is that you've essentially been making concessional contributions, so you're essentially saving on tax because you've only been paying 15% instead of your own marginal tax rate. The last strategy relates to non-concessional contributions and is taking advantage of the transfer balance cap. If you're already investing your money into assets for the purposes of funding your retirement, it could be a smart tax strategy to place those investments inside your superannuation versus outside by making non-concessional contributions. As I mentioned earlier, you won't get an immediate tax saving on these non-concessional contributions, but you can significantly lower the taxes you'll have to pay later on in life. And allow me to explain. Firstly, any investment returns like dividends and income streams that you receive inside your superannuation account will only be taxed at 15% during the accumulation phase, versus if you held those investments outside of super, where you would be taxed at your own marginal tax rate. So if you received $10,000 worth of dividend income inside of super, you would only be paying $1,500 worth of taxes, versus outside of super, assuming you're on the highest marginal tax rate, you would be paying $4,500 in taxes. That's a tax saving of $3,000 just for holding your investments inside of super versus outside of super. Secondly, from age 60, if you're retired, you can actually transfer your superannuation balance into what is known as a pension account. In this account, any earnings on your investments, whether it's interest, dividends, or capital gains, are completely tax-free. This is compared to if you had your investments outside of super, which you would still need to pay capital gains taxes on. The pension account is currently capped at $1.9 million, which is known as the transfer balance cap. Now, this is indexed to inflation, so the tax will continue to increase over time. And by the time I'm 60, it's most likely going to be over $2 million or potentially $3 million. By making a conscious decision to make non-concessional contributions into your superannuation accounts, you could get to a state where you have over $2 million in investments where you need to pay $0 in taxes. And those are the 7 superannuation strategies that you can use to legally pay less tax in Australia. Let me know what strategies you guys are currently using, and if you guys liked the video or learned something new, then hit that like button down below because it really does help me out. And comment the word savings down below so I know that you watched the whole video. And if you do feel so inclined, then feel free to also subscribe to the channel for more personal finance tips and tricks in the future. And if you want to learn about tax deductions that can help you pay less tax for this year's tax return, then make sure you watch this video right here.